Uh,
Okay, so good morning and thank you for joining us. Welcome to our Atleha-edu dialogue on investing on the stock market. I'm Sandy Nelson and I'll be your host for today. So before we go any further, we'd just like to thank our funder Fiatri for making today's online dialogue possible, as well as for funding the content that will be used during this today's session. So we're just going to do a round of introductions. I'll start off and then I'll hand over to my colleague Mohammed and Nosipo once she's joined, and then also the delegates who are joining or those who are able, because I said there are some who are struggling with some audio issues. So those who are able to just introduce yourself, your name, your role at your union or your retirement fund, and what it is that you'd like to get out of today's session. So I'll kick us off. Like I said, my name is Sandy Nelson. I am one of the administrators, content creators, and facilitators of Atleha-edu. And in my full time, I'm an ESG advisor at Six Capitals Advisory alongside Mohammed. And I've been with Six Capitals for over 2 years, almost 3 years now. And yeah, I hope you guys enjoyed today's session and that you're looking forward to receive. I'm sure Mohammed has a lot for you guys. So I'll hand over to you, Mohammed.
Good morning, everyone. As Sandy mentioned, the name is Mohammed. I'm a specialist at Six Capitals, where I primarily focus on climate change, and in my spare time, help the Atleha-edu team on some of the facilitation and workshops as well.
Thank you, Mohammed. Nosipo, I see you've joined. If you're able to, could you please maybe put on your camera and also just introduce yourself, please? Thank you.
Hi everyone, I am Nosipo and I'm an intern at Six Capitals. I work along with Sandy and Mohammed. I mostly assist on the education side. Yes, thank you.
Thanks so much, Nosipo. I see Karabo still hasn't been able to rejoin us. Kadimo, is it possible for you to introduce yourself, please? And just maybe mention what it is that if you have any questions that you'd like Mohammed to answer throughout the course of today's session, or what it is that you're looking forward to receiving out of the session today.
Good day, everyone. My name is Kadimo Lesetedi. I'm from Sylvania Metals. I'm a shop steward, and I would like to get more insight on the stocks that you are supposed to invest on. I've always been interested in learning more about them.
All right. Thanks so much, Kadimo. Karabo, I see you are back. So if you are unable to speak,
I don't think his sound is working from what I see on the side. So we'll just jump right into it. As long as he can hear us, I think it's...
Yeah, Karabo, you could
great.
please use the chat function if you have any questions.
I think his sound is back.
Karabo, could you test if you'd like to maybe go ahead and just introduce yourself so we could see if your sound is working? It's unmute. It's unmute. You can unmute, yeah.
Okay.
There we go. Now we can hear you.
Okay. Sure, it's fine now.
It's fine. Could you just introduce yourself and then tell us what your role is at your union or retirement fund, and also what it is that you're looking to get out of today's session?
Oh, hello everyone. I'm Karabo. Just that I've joined your meetings, so I'm just on the union. I'm a shop steward. NUM.
And is there anything specific you'd like to get out of today's session, or any specific questions you have for Mohammed?
No, I don't have questions at the moment.
Okay, then no problem. Thanks so much. So then, without any further ado, we'll go straight into the session. We'll hand over to Mohammed, who'll be taking us through the content that we're focusing on today. And if you do have any questions while Mohammed is speaking, feel free to raise a hand or just drop a question in the chat section. Thank you.
Okay.
Straight over to you, Mohammed.
Good morning again, everyone. So maybe just to start, like to thank you guys for joining us on today's journey. Almost start with a personal story. So several years ago, or just when COVID started, had some free time on my hands, dipped my toes into the world of investing in the stock market. Like everyone else on the call, had little knowledge about the stock market, knew that there's these companies like the companies that you guys work for, Sibanye-Stillwater, and the various mining companies. That was like historically what we knew about the stock market from a South African perspective. And over time, learn some of the ropes, still learning. There's incredible potential on the stock market to build your wealth. And I think we are to share some of the knowledge that I've gained from a personal perspective and some of the knowledge that the team has put together as well. So it's the stock market is not just a financial skill, but it's a life skill, because it secures your future and your children's future, because depending on the companies that you invest in, it's a long-term investment. It's something that generates returns for you every year and helps your portfolio grow and your own asset portfolio grow. So maybe just to almost start and understand the stock market, right? What is the stock market? So you can almost imagine it as this bustling marketplace where investors, both large and small, so large like your pension funds and small like me and you, trade shares of these publicly traded companies like Sibanye-Stillwater, Exxaro, Anglo American, and these shares represent ownership in these companies. So depending on how many shares you own, it gives you a certain size of the company, and you therefore have influence in that company. But before we dive deeper, let's look at the historical performance. Over the long term, the stock market has shown remarkable growth, but it should be noted that there's occasional up and downs. So COVID was a good example. Before COVID happened, the share price of Cecil was at about 200 to 300 Rand. And when COVID took place, when the height of the lockdown, the share price dropped to 30 Rand. So you can imagine some people lost a lot of money, but then there was also opportunity for a lot of people to make a lot more money, because a lot of people invested it when it reached 30 Rand, and now the share price is back at 300 Rand. So if you invested when the share price was at 30 Rand, you almost made 10 times your money, right? So if you invested 1,000 Rand at 30 Rand, you now made about 10,000 Rand at its new price of around 200 to 300 Rand almost, right? So we've seen this, the footage from movies like Wolf of Wall Street of all of these people in suits looking at these boards in the New York Stock Exchange with all these numbers going up and down, and everyone's in a bit of a there's almost frantic activity. But today things are a bit different. You can get access to that information on your smartphone through platforms like Easy Equities and some of your banking apps as well. And so maybe just to understand why companies sell pieces of themselves, I think it's important to understand why companies need to invest on the stock exchange. So almost for a company to grow and expand, similar to us when we want to grow our own lifestyle, and that we either apply for a loan, we take profits from or at least our salary and put it into businesses that we want to start, or we convince other people to invest in us, and for companies, there's an alternative option, which is listing on the stock exchange and getting money from the public. So one of the benefits of investing, of raising capital on the stock exchange, is you can get access to large amounts of capital without things like interest, right? So in South Africa, how did the stock exchange begin? It all started back when gold was discovered in 1886, and a lot of new companies were formed at that point. So both in the mining space and adjacent to the mining space. So you'd have your equipment manufacturers, etc. So all of these companies needed money to grow their businesses. Specifically, the mines needed money to buy equipment and manage their operations, and then the banks needed money to be able to support the miners get bigger and finance that equipment. So there was almost this need for a central place to trade, and this happened in a miner stand, and then moved to Sawa and Commissioner Street in Joburg, and the JSE was founded on 8th November 1887. So understanding so it's important to note, right, as we mentioned earlier, that investing in the stock market isn't without its risks. It's crucial to acknowledge these risks upfront, and it's important to, as an investor, be cognizant of this, because the markets are volatile, investments go up and down, but with knowledge and strategy, you can navigate these waters successfully, and also invest at the right time and know when to sell your investments and create growth for your portfolio. So why invest in the stock market? What are the benefits? First and foremost, it's a powerful tool for wealth creation, right? And this is through the magic of compounding returns, because if you invest small regular investments, they can grow into substantial wealth. The other aspect is there's tax advantages. So South Africa has a tax-free savings account, which allows you to invest up to 36,000 annually. And this is through it's a tax-free scheme, and that allows you to, when you get dividends, and when you take that money out at a later point, when on retirement, then there is no tax on that, right? And I think the other important thing is diversification. So keeping your money in the bank with interest rates is great when interest rates are high, but when interest rates are low, like during COVID, your money didn't grow with inflation. So the stock market generally grows above inflation, which allows you to protect your capital. So when a company lists on the stock exchange, it must issue shares in the company. Investors such as yourselves and retirement funds can buy shares and own a small part of the company. We are called shareholders if the company performs well. Shareholders receive a percentage of the profit, which is called a dividend. This dividend is another source of wealth, because it's paid either annually or biannually, so twice a year. And also shareholders are allowed to vote on certain matters in the company at the AGM, which is the annual general meeting. While the shareholder owns shares, the value of these shares can increase or decrease, creating the opportunity to profit when the share is sold at a price higher than what was paid. So that's where the opportunity comes in of creating additional revenue aside from your dividend payout, right? Aside from the JSE, South Africa has several other stock exchanges like the Cape Town Stock Exchange, A2X Marketplace, and Equity Express Security Exchange. But the JSE is the largest, not only in South Africa, but in Africa itself, right? So two types of trading takes place at the stock exchange. The first is when companies raise capital by listing on the exchange and selling their shares to investors for the first time. In finance speak, this is called an initial public offering, or otherwise known as an IPO. And once a company is listed on the stock exchange, investors buy and sell shares to make a profit. The company does not receive any money, and this is called a secondary market. So for example, Sibanye-Stillwater has a certain amount of shares. Say it has 1,000 shares on the market. The first time they list, this is when they get the money. But post that initial listing, when I sell my Sibanye-Stillwater shares, it goes into a pool, and Stanley can then buy that share. But Sibanye-Stillwater does not generate revenue from the transaction between myself and Sandy. They generate their revenue from the money that they make from the initial sale of the shares. So going into getting started with stock market investing. Now, how do you get started? I think it always begins with setting clear financial goals, right? You need to have short-term and long-term objectives, because this will shape your investment strategy. For example, some companies you need to invest with a long-term horizon, while some companies it's a more short-term horizon. So to give you an example, Tesla is a great example of short-term investing. When the market sped up significantly in 2021, you could generate a lot of money over a very short horizon. But some companies, like the mining space specifically, you invest today, you get a good dividend yield. So every twice a year, the company will pay out dividends, and that's where you're generating your revenue, while the share price doesn't appreciate as rapidly as some of the technology shares, right? And then aside from that long-term and short-term objective, you also need to consider your risk tolerance. So are you comfortable with more aggressive, potentially higher return investments, or do you prefer a more conservative approach? So higher risk, a more aggressive risk return component will make you prioritize shares in the stock in technology. So for example, Microsoft, all of these companies that operate in the technology space. But a more conservative approach would have you investing in shares like the banking shares in South Africa, right? So ABSA, Standard Bank, those that sort of a market. So understanding your risk tolerance will also help you to decide your capital allocation and how you determine your portfolio mix. So generally, what many people advise is to have a mix of your of short-term and long-term objectives, and also a mix of risk tolerance. So you'll split it 70, 20, 10. So 70% will be in the more conservative shares. 20% will be in medium risk, and then the final 10% would be in higher return, higher risk shares, right? So that allows you to not lose all of your money at once, but also allows you to generate rapid returns in times of in up times. Then from once you got your goals and risk tolerance sorted, it's time to open an account that will enable you to trade on the stock market. So there's traditional brokerage firms and online platforms. So there's CompuShare is an example of a traditional brokerage firm, and then online platforms like Easy Equities is a great example of new technology coming into the stock market. And all of these have pros and cons, right? Easy Equities has very low barrier to entry, so you can invest with values of as low as 100 rand, and that allows, because the cost to invest is so low, it allows you to invest easier. But it's there's less guardrails, from the sense that you are allowed to do things more flexibly. You make your own decisions, and there isn't that protection that investing through a traditional brokerage offers. So now that you have an account, how do you choose stocks? So there's this is where it becomes complicated. There's fundamental analysis and technical analysis. So you look at companies' financial health and potential for growth. So you look at things like integrated reports and financial reports to see how much money are they making each year, and look at over a 3-year horizon, how has things been going from a Sibanye-Stillwater perspective, using Sibanye as an example again. So 2019 they made so many billion. 2020 they made so much more, and see how their growth is going, so that you can understand how the business is growing. And then technical analysis looks at the price charts and patterns. So regardless of your approach, thorough research is essential, because it allows you to reduce the amount of mistakes you're going to make and protects your investments, right? But on the flip side, there is experts that do this for you. So you can, so for example, your retirement fund, right? I'm sure all of you at in the stock in the unionized space have access to retirement funds, either through your pension fund or through alternative options that your companies have set up for you. So you do this monthly contribution towards your retirement fund. But where does this money go? So first, in most instances, it goes towards the largest companies in South Africa, like Vodacom, Shoprite, Pepco, Sibanye-Stillwater, etc. So your company's retirement funds pools the contribution of all staff, and then this fund then invests this large pool of money with an asset portfolio, with the asset manager, with a specific mandate, right? And this mandate guides the asset manager to pursue expected returns, manage risks, and invest in a portfolio of preferred asset classes like equity, which is shares in companies, properties, or commodities. And the asset manager allows you to, at least when you're dipping your toes into the stock market, these asset managers will have the knowledge and capability that you and I might not have immediately, to be able to guide your spending of money to the appropriate companies. And but in effect, the asset management company manages this giant pool of money. And because they have this capability and knowledge, they the risk of losing your capital is lower than when you invest directly into the stock market yourself. But I think I've spoken a lot, so I'm going to take a quick pause here and ask if there's any questions before we proceed to the next phase of the presentation. Karabo and Kanimo, is there any questions from your end?
No, I'm still fine. I'm still fine.
Have I given you a lot to chew on?
Yes, I'm still listening to you.
Okay, cool. So maybe going
On my side,
yes.
that means after COVID, I missed out a lot because I've been using easy equities, and I was not aware that the shares for Sasol had dropped so much. So it's an eye opener for us to keep on tracking our investments from time to time.
Yeah, no, so active management of your portfolio is important, right? So maybe just to give you two examples of events that shook the market for all intents and purposes. The one was COVID. So if you looked at the stock market prices before COVID, a lot of the assets were trading at very high prices. So like Soho Sun, which owns Sun City and all of the casinos, trading at good prices. When COVID happened and the lockdown happened, everyone understood that because of the effect of COVID, these companies were not going to make as much money as they made previously. So the share price collapsed because of COVID. But then when it reached a certain point, investors knew that now there's value, because when lockdown ends, these companies are going to come back stronger. And because you invested at such a low point, the opportunity to make a lot of money is there. So like I think City Hotel Group, their price went down significantly, and a lot of people made a lot of money by investing when COVID happened. So they almost made 10 times the value of their money because of COVID. Then the second big event that happened recently was the Russia-Ukraine war. And if you invested in coal miners like Exxaro, South 32, Seriti, before that war happened, you would have made a lot of money, because the share prices of these companies increased substantially because they made a lot of money in COVID. I mean, because of the Russia-Ukraine war, because coal prices increased substantially. And because of that increase in price of coal, these companies returned a lot of money to shareholders. Just to give you an example, when Tungela listed on the stock exchange, they listed at 30 Rand. Their first dividend was 60 Rand. So, and that was, even if you never take your money out of Tungela, the first dividend that they paid was twice the amount of, you made 2 times the amount of your initial investment. And the share price went from 30 Rand to 200 and something Rand within the space of a year. So a lot of people made a lot of money by following the news, understanding where the market is going from a global sense. So understanding where all of this, where the world is going, because if you understand where the world is going, you know, these companies, because of what they do, they're going to capitalize on the trend. So for example, recently, I don't know if you guys are aware of AI, artificial intelligence, that has become a big topic globally. And because of artificial intelligence becoming this big thing globally, a lot of the stocks that were, or companies that are important to the AI journey or the AI market, has skyrocketed in value. So sometimes you need to also understand the news cycle. You need to understand the company's growth itself. So you need to take all of these factors into account and make an investment case, and then invest into an asset, right? So the research is very important in stock selection. Kadimo, I don't know if that helps you with why it's so important to actively manage your stocks or your investments.
Okay. A quick question. Now, for a busy person who's maybe working during the course of the day, how do we manage balancing the research and then also focusing on work at the same time? Because some of us, we are doing investment as a way of side hustle apart from our jobs.
Yeah, so there's almost two approaches, right? So the first is the simple one where you invest in ETF or into one of these asset managers funds. So for example, an ETF would be tracked to a certain uh, type of stocks. So for example, you'll have minerals or mining stocks, right, within the ETF. And that also allows you to get broader exposure to a sector. So for example, if you invest in a stock, you're investing in either Sibanye-Stillwater or Anglo Gold Ashanti or Anglo Platinum. So you only invested within a single company. And there's risk by investing in a single company, because if that company doesn't do well, your entire portfolio does badly. But if you invest in the broader sector, so for example, if you invest in platinum group metals ETF, right, you're investing in a basket of companies. So you're investing in all of them. So if one does badly, it doesn't affect all your money, because you still relying on Impala Platinum to help to keep the portfolio up. So you can invest in ETFs, which helps reduce the amount of research you need to do, right? But you still need to research those ETFs. The other one is uh, you 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 uh, you research at nights. It's something that once you get the hang of, and once you follow the right people on Twitter and LinkedIn, you can get an understanding of where the market is going in some instances. So a nice podcast to listen to is the Money Show on 702. The Bruce Whitfield, I think it's between 6 to 8. When you listen to him, you get the understanding of where the market is going, and it also helps build your knowledge base as well of of uh, of where the stock market is going. And you can sometimes get insight from him on certain key topics. uh, you can, so there's several of these money podcasts that happen on the internet that you can follow and listen to some of these people, but you must understand that there's still risks by taking the advice. And it's, at the end of the day, you need to also be comfortable. So I think you need to have a balance. You need to invest in some of these ETFs which track the whole market. So there's nice ETFs that track the S&P 500, which is the American stock exchange. Then there's ETFs that track the South African JSE Top 40, which is also nice to invest in, because it's broad based. As the market grows, your portfolio grows, and generally it's uh, if you look at the historic trends, it's always grows above inflation. So nice to have some of those in your portfolio, where you don't need to actively manage your portfolio because you're investing in the S&P 500. So you have this broad array of companies, and the effect of one of these companies share prices going down doesn't affect your whole portfolio. I hope that helps.
Thanks a lot.
Okay, cool. So moving on. So maybe just to go back to the asset managers, how does my retirement fund achieve returns? So the retirement fund is a very long-term investor. It generally holds on to shares in companies with the aim of increasing their value over time. As the value of the shares increase, so does the monetary value worth of the retirement fund. By buying shares in companies that expand and perform well, the fund then gains from either receiving dividends or selling the share at a higher price than when it's bought. So similar to how you would deal with the stock market, retirement funds do it for you in a similar approach. And it's also because of economies of scale that it makes it easier for them to hire top talent that understands the market better than you and I, and they have the capability to do research on a day-to-day basis, unlike us who have our day jobs. So they'll invest hundreds of millions of rands, and they have these experts, actuarial scientists, and financial experts to make these decisions for you. So sometimes it tends to take the risk away, but the reality is that there is a fee associated with it, but for the most part, you generally tend to have a more stable and safe return on investment. So maybe just to talk about why can't a retirement fund invest 100% of its money on the stock exchange? Investing in shares can be risky. There could be no bias for your shares. So this is more prevalent with small companies or companies in distress. So an example of this would be Steinhoff, which was the owners of a bunch of clothing brands a few years ago, but they had some financial irregularities, which resulted in the share price going down significantly, and nobody wants to buy those shares. So there's a limited liquidity in that, right? So the listed company could go out of businesses, or the returns received through dividends and capital gains when shares are sold can be lower than expected. So they generally invest. So the retirement fund doesn't invest 100% of its money on the stock exchange. They'll invest in government bonds, which basically means that government needs to pay interest to the retirement funds for taking ownership of government debt. They'll also invest in property, so they'll buy things like malls, etc. So similarly to retirement funds, it's important to note that you as an individual, all your money shouldn't also be invested in the stock market. You should invest it in the bank through money market accounts, which is linked to interest. You should invest it in is a portion of it in the stock exchange, and a portion in property companies or companies that have exposure to properties. Okay, moving on. So going back to this topic of a diversified portfolio, you shouldn't put all your eggs in one basket. COVID showed that diversification is key to managing risk, because even when COVID happened, certain share prices went up, like the pharmaceutical companies, because investors knew pharmaceutical companies are going to make more money because of COVID, and certain share prices went down, like hotel groups. So you have to think of your investments as a piece of a puzzle, and by spreading them around different sectors and asset classes, you reduce the impact of a single company's poor performance on your overall portfolio. And similarly, so on one end, you need to split your stocks across this broad range of assets in the stock exchange, and on the other side, your actual portfolio of assets should be a mix of stocks, a mix of money in the bank, a mix of money in property. So you as an individual should also have not just your stocks diversified, but also your money split between different asset classes. The stock market isn't a get rich quick scheme, right? Successful investors like Warren Buffett has taught us the value of patience. Warren Buffett's one of the richest individuals in the world, and he says value investing will make money over the long term more than get rich quick schemes. So trying to time the market or engaging in frequent trading often leads to losses. Sometimes it's important to take a long-term perspective and stay the course. So for going back to COVID, when you invested in Cecil, you knew that it's going to be a long-term thing. You're not going to make your money today. It's not going to go up 60 Rand tomorrow and you're going to make double your money, but you knew you're going to wait 2 years until COVID ends to actually make real money and get the 10 times value, right? So you need to take the long-term perspective. You need to stay the course, because you're making money for your end goal should be to make long-term value for yourself and for your children and grandchildren. And then lastly, or almost one of the last points we need to discuss is risk management and emotional control. Implementing, so a lot of times when we look at, if you open your Easy Equities app and you see everything in red, you get a bit of a shock. And it's important to consider that the stock market does go up and down. So you can implement strategies like stop order losses to protect your investments. What a stop order loss does is when the share price is starting to dip, at a certain point, the computer or the application will sell your shares automatically to protect your investment. So for example, you invested in the share at 100 Rand. Now the share price is at 200 Rand. You put a stop loss order at 150 Rand, so that if the share price does go down significantly, you still made the 50 Rand. And that protects your investments from losing value quickly. You need to remember emotions cloud your judgment. Stay informed. Don't let daily fluctuations drive your decision. So again, going back to that long-term view and the importance of patience, the stock market fluctuates daily. You will see some companies will drop significantly on a daily basis, depending on how volatile the stock is. So you need to know your horizon when you invest in that business. So for example, you say you want to invest in technology, you know that's going to be a volatile space to invest in. you need to understand that, am I investing for 6 months or am I investing for a year? Or am I investing for 3 days? You need to know that the time horizon. So if it's a 3-day thing, you need to be very prepared to look at that stock every day, every hour. You need to be on the ball on it. But if it's a 6-month profile, you don't need to look at that share for the next 6 months, because you know in 6 months, because of XYZ factors, that stock is going to be significantly higher than it is today. So you don't need to worry about what's happening on a day-to-day basis, because your horizon is 6 months. And that allows you to safeguard your emotions. I know some people, when all of this was happening in 2021, when COVID happened, it was a scary time for many people. A lot of people uh, were worried about what's going to happen to their portfolio. But what Bruce Whitfield said was, be patient. There's a time to make money as well, because the stock market is low. So there's this thing where people are greedy. You need to sell, because that means the market is hot. So when everyone else is being greedy, you need to sell. And when the market is fearful, you need to buy, because that means when everyone is selling, that means there's opportunity to buy. Obviously, you need to time your buying and selling appropriately to maximize return on your investment. But you need to be informed, understand the news cycle, take it into account when you're making these transactions, right? So in conclusion, investments in the stock market is a powerful way to build wealth and secure your financial future. Understand the market, set clear goals, understand risk, manage your risk, stay patient and rational, and you can generate significant value. So my advice to you is, you need to start the journey small. Don't invest all your money at once. Learn, invest. If you have money, invest in the tax-free savings accounts, because that's a long-term tax-free savings option. And through that, you invest in ETFs. But my advice is, seek advice from professionals. Remember that you need to build that knowledge and capability, right? That helps you unlock the doors to financial success. Speak to people in companies like Fairtree and other investment houses. You need to first build your own capabilities. You need to invest through these companies to build your initial portfolio, and then you can dive into stocks once you have a more clear understanding of how the stock market works. Once you have that capability, then you can invest but my advice is, start small and build up. Don't bet the house on the stock market, if that makes sense. I'll stop here for questions. And again, we just need to put a disclaimer: we are not financial advisors, and all of this is at own risk. But you need to build your knowledge from the ground up. Build slowly, start small, work with asset managers, and take your time to invest and understand the stock market before you start investing all of your money, and treat it as a opportunity to grow your capabilities and to grow your portfolio.
Okay, Muhammad, I've got two questions. The first one is, what does limited liquidity mean? And then the second one, how will we know that people on the stock market are starting to get greedy? Because the way you are saying, it's as if we are on a trading platform where people trade Forex. There we are able to know how people are greedy, or how we ourselves as traders are greedy. But on the stock exchange, how will we be able to see greedy people?
Yeah, so I think, so on the first one, limited liquidity means that, so for example, there's 1,000 rand, right, of shares, but that 1,000 shares are owned, 80% are owned by one person. So now there's only 200 shares available, right? So generally, when shares are owned by when a lot of the shares are owned by one person, there's limited liquidity, because there isn't many people selling that share, so basically it goes down to that point where the market is not buying and selling that share so much. So you generally see it's between when you see that there's one owner of the bulk of the company, you'll see that there's limited liquidity. You can see on easy, maybe not easy equities, but on some of the other platforms, how many shares were sold in the company on a daily basis, and that allows you to determine the liquidity of the share. So companies that don't trade frequently, to sell your shares, it's hard to sell them when you want to get out of that asset. So for example, you buy a company, those shares only sell once a year. You're probably not going to be able to sell it when you need it, for example. So say you have a financial crisis, you need to sell it immediately. You're probably not going to be able to sell it immediately, right? So you can generally try to find the information online where you see how frequently the share trades. So if you see frequent moving of volume of that share, you'll know that it's a liquid share. If it doesn't move frequently, you know it's an illiquid share. Then on the topic of greedy and how do you know when the market is getting greedy, that is something that when you listen to this financial podcast, you can start getting a sense of where the market is going. So if you listen to Bruce Whitfield and others in the space, the guys that are talking about the money markets or the stock market, you'll get an understanding of they have these asset managers that come onto the programs almost daily basis who talk about the stock market. They give their advice on where the market is going, and once you start hearing the story, the narrative that these guys are painting, you'll understand whether the market is hot or cold. It's in a bull cycle or bear cycle. So bull cycle is it's growing, a bear cycle is it's going down, right? So that sort of a thing happens. You get all of this knowledge from, and you can even read on business today, that sort of articles. You can start getting a sense of whether the market is greedy. And again, it's when you start getting the knowledge, you can start building your own picture and start painting your own picture, right? But yeah, I hope that answers you.
Thanks.
Karabo, any questions from your end?
Nah, no, I'm still all right.
Okay, good. So maybe just to almost come to a conclusion, we've given you advice. We haven't given you financial advice. What we're saying is, speak to asset managers, speak to the experts in the space. They will give you better guidance and help build your portfolio. Knowledge is power. Build your own internal knowledge and capabilities, and then from there, hopefully you'll reach financial security. Sandy, over to you.
Thanks so much, Mohammed. Seeing that we don't have any more questions, or there are nothing else that Karabo or Kadimo would like to ask from Mohammed, I first just want to say thank you for joining us for today's online dialogue. And by all the questions, I can tell that you found it very insightful and educational. And if there are any other things you'd like to find out regarding investing on the stock market or just investing in general, we have a number of articles up on our Atleha-edu website, as well as some videos, infographics, recordings that you could listen to, the works basically. So please do go and have a look at our Atleha-edu website, where you'll have access to all the content that we've created thus far on the stock market investing and just investing in general, and also how this is tied to your retirement funds. And I think then that is it for today's session. We'll be having another online dialogue tomorrow on real assets, operational real assets. So this will be presented by Adrian Bertrand. So if you are available, the link has been made available in the group where you would have found or registered for this dialogue as well, in our Atleha-edu group that most of or some of you belong to. So please register for this session. And if you do need any assistance with data, please do send a direct message to that Atleha-edu number or to Nosipo. She'll find her number as well in that group. So please feel free to contact us regarding any data assistance or anything else regarding, or any questions that you might have. You can contact myself, Sandy, at 6capitals.co.za, or nosipo@sixcapitals.co.za, and we'll be able to give answer your questions or give you information regarding our next workshops, whether it be online or in person. And then once again, we'd just like to thank Faitri for funding today's online dialogue and also all the content that Mohammed has shared with you today. And I hope to see you guys soon. Thanks so much. Thank you, everyone. All right.
Thank you, everyone. Cheers. Bye-bye.